supplement Propenomix Live. So this week's supplement was called Inflation Back to the Real Target. And that's a reference to my belief that the real target for inflation these days is more like 3%. And that's where we hit in the UK last week. So if you've listened before, you'll know that I like to start with a quote. And this week's was, and in the end, it is not the years in your life that count, it's the life in your years. And that's from Abraham Lincoln, the former US president. Now that was an attempted reference towards the fact that we seem to be more marking time in the UK economy over the last recent years, often been blamed on various different things, whether it's been Brexit, whether it's been the pandemic. And of course these things have had and do have a significant impact, but we seem to be fiddling around 0% sort of growth, stagflation, whatever you want to call it, and that's why I use that quote. So before I get started in earnest, I just wanted to tell you about the next property business workshop, which is Tuesday the 1st of April, where the topic is due diligence. Now this is an entire day dedicated to due diligence, back after popular demand and expanded on our last due diligence workshop from 2024, where we also covered 2 other major topics. So we've got fresh content and ideas, and we'll be covering due diligence on potential business partners and suppliers, due diligence on deals, due diligence on lenders and borrowers, the health of companies and what you can and can't rely on from Companies House, liquidation, administration and receivership, due diligence on deals with limited time or information available, credit ratings and how they really work, financial promotions and the FCA, and a live due diligence exercise on some individuals and companies using some online tools. Tickets are live and they're selling already. bit.ly/PBW and then a number 6. The super early bird tickets have got a genuine 25+% discount on face value, and when they're gone, they're gone. There's only about half a dozen of those left. So if you are thinking of coming along to the workshop, please make a move and book those tickets so you can get the super early bird pricing. I'm also collaborating with a couple of others to deliver a course on finding deals. Due to time constraints, we only run a maximum of 2 of these per year, and it might indeed only be 1 looking at the calendars for 2025. So alongside Dan Kennedy and Nick Bond, I'll be there. This is Birmingham based, talking through no holds barred, the methods we use on a daily basis to find a healthy stream of property deals, whether you're looking to buy them for yourself, become a property trader, or earn an extra income stream through sourcing for others. Now, why do we run these? People often ask me. Well, as per any of the training I get involved in, we're doing it with 90% of our time and talking about it with 10% of our time. That puts us in the right place to get real world and up-to-date information. It's also a brilliant way for me to help expand my network with people who are committed to developing themselves and also potential, therefore, future business partners or people we might do business with. So it's great value, it's very intensive over the 3 days, and as always, it's packed with content. We've sold 9 tickets, we've got 11 remaining. That's the right number, so we can make sure we get into the right level of depth and detail with everyone. And even if we sell no more tickets, we'll be going ahead with 9 people, and it'll be a fantastic course. But 20 is the limit, and if you're interested, it's propertymatchmaker.uk/sourcing-solved. So, enough of that. Welcome to the supplement. Plenty of macro here to keep us busy in a week where Trump once again appeared to take a position that horrified a good slice of the population. His openness about the purpose of war and value of materials is some sight to behold. The most commercial approach to a war situation ever, I would say, or at least the most openly commercial anyway. In other news, he is now the bookies' favourite for the Nobel Peace Prize. That's right, at 6-1. So this week's deep dive sees a double header of 2 reports that I wanted to get stuck into over the past couple of months. Both are looking at the fortunes or not of those between 25 and 34. The renters of today, are they the homeowners of tomorrow or in the next decade? Then in the real time slot, Chris Watkin and the Property Market Stats Show deliver again. We get to ask that question that we love to know the answer to week in, week out. What is currently happening in the UK property market? And interestingly, just as an aside, I've just started to see people who are actually talking about the UK market and why there are so many people on the market, why there are so many properties on the market at this time. So there are so many properties on the market because landlords are selling up. And I've known about this for a long period of time and I've been writing about it, talking about it, blogging about it. And ultimately, that is because of the changes in the interest rate, primarily, apart from anything else. That's because of the changes in the overall landscape, the property landscape, the sector. And this is what you're going to see over the next few years. I think they're going to continue to put landlords off. They're going to continue to make sure that it's not an attractive market for landlords. And finally, this is starting to be recognised in the industry press at the moment. And I think it will be recognised much more widely going forward as well. So this is week 6 of the real-time market. So we operate 1 week behind actual real-time. And we're seeing the listings data continuing to normalise. 2025 is still the biggest start to the year for listings since 2016, if not before. Chris's data only goes back to 2017. It's now 9% higher than the 2024 number, which, other than 2025, was the highest year for listings in this sample. And it's 20% ahead of the pre-pandemic average. So 12% of stock was reduced in week 5, and that compares to 2024's average. So, as I say, a market of more stock, just as this one looks like, of 11.9%, although the 5-year average is 10.6% for reductions. So what's that telling us? More stuff on the market, more reductions by percentage, many more reductions to go after if you're looking to buy any kind of property, but investment property particularly, if you're particularly price sensitive. The gross sales sit between 2021 and 2022's, although we're now on the lower end of that range. 27,600 homes sold subject to contract in week 6, 30% higher than the pre-pandemic. 22.2% fell through, which is still below our 7-year average of 24.2. Net sales look similarly outsized, 21.4 thousand, which is 24% higher than the pre-pandemic 3-year average. Now, I like to give Chris Watkin a bit of weekly love here because he's more prolific than just this epic tome he releases weekly on the UK market. Comes up with great stats on a regular basis. Drop him a like, a subscribe, and all the rest of it. And if you could do that for my channel while you're at it, that would be much appreciated. But he comes up with these brilliant stats, and drop him some kind words for his content creation. If you're in the property industry and you want a ghostwriter, that's his core business, so give him a shout. The article that I refer to gets published on the Property Industry Eye website, and the video goes on his YouTube channel. It's about an hour long, called the Property Market Stats Show, and that's at Christopher Watkin on YouTube. Okay, so I'm going to glide from the real-time UK market to the macro segment like a swan. Mega week includes unemployment and the labour market, inflation. Oh, you noticed that, did you? Flash PMIs because it was February, so it's a shorter month. And then you always know we sign off with the gilt and swaps market overview, of course. So, the labour market, how is it? Blood on the carpet yet? Well, it seems not. There was a pleasant surprise as economic consensus suggested we would hit 4.5% unemployment for December, but instead we held hard at 4.4. Perhaps that was no surprise given last week's growth figure was far better than expected for December in isolation. And then the employment rate stayed very nearly at its desirable bottom of 75%. By printing 74.9. Inactivity is down to 21.5%. Now, if you're paying attention, you'll notice all those three only add up to 99.8. So there are a few rounding bits in there. So all of those, it's fair to say, are above their point ones there somewhere. We've got 0.2% to find. But that's typical with the ONS. So, vacancies decreased on the quarter once more, but the pattern looks to have been snapped off anyway, for the moment. After next month's figures, the likelihood is that it would have been the first up quarter for the number of job vacancies since the bottom of the pandemic. In other news that makes the bond yield needle move, wage growth, which was expected at 5.9%, slightly exceeded that by printing 6%, including bonus. We also lost 52,000 working days to labour disputes in December 2024, which is just mind-blowing to me every time I see that statistic, but there we go, 52,000 days of work. Real earnings growth thus still printed 2.5% when adjusted for CPIH. So remember that's CPI inflation, but including housing costs. Now that's about as good as it gets, but it will suffer as inflation rises, of course, particularly if wage growth now starts to normalise more, as is expected. And it's already been normalising. It's come back from 8% or more, and it's now back to the sort of 6% territory, although it did dip down to the sort of 5s, and it's gone back to 6. So it's more stable than the Bank of England would like if they're looking at a world with 2% inflation, which they're still pretending that they are, of course. So it's good to see things holding up a bit better than we'd hoped, though, but the next 4 or 5 months are massive as we approach this April tax hike, the employers' national insurance changes. Hopefully it's a big fuss about nothing. It's impossible to imagine there'll be no impact whatsoever, but hopefully the impact will be swallowed by other bits of the economy, other sectors that are still growing and creating jobs. So, inflation, is that worse? Well, we all knew it was going back up. Some of us have been saying for a while that 3% is the new 2%. Happened a bit quicker than anyone thought, and for an obvious reason when we were told about it after the event, the dreaded VAT on private school fees. That manifested itself in a 12.7% rise in 1 month, as the schools considered their VAT reclaim positions and chose to pass on those savings and levy the net VAT position, which is what you would expect them to do. The ONS, as you may well know by now, prefers to measure progress, or lack of it, by quoting CPIH, including that housing element. So CPIH is 3.9%. And why is it continuing to outstrip CPI? Well, because rents and mortgages continue to go up well beyond the level of inflation generally. Core CPIH, stripping out food, energy, alcohol and tobacco, was 4.6% up year on year, well above the 3% headline rate here. The headlines were captured by CPI, as always, and that 3% print was 0.5% above the 2.5% print for December and 0.2% ahead of the expected 2.8% print. A miss to the upside and a miss to the downside on unemployment. Now, both of those would normally send negative signals to the gilt markets, which would push prices down and yields up. But that's general, and as I say, not a bond trader, never been a bond trader, and that's one of the reasons why. But what you have to do is you look at the market in these situations, and if there are clear signals that the market doesn't really listen to, what that's a general sign is that the market overall is actually going to be coming back rather than going in the direction you might think it would. So what does that mean in this instance? It means that bond yields are already high enough, which I've also been saying for quite a while. There is an acceptable range for them to trade into, and they've been trading at or near or even above the high end of that acceptable range. And so the market now, I think, is understanding that and is not seeing them drift as much as they once did. So core CPI was also up. You can imagine it would be. You see the pattern to 3.7, and services inflation moved back from 4.4% to 5%. I've said 50 times at least in the past few years, none of this is congruent with a 2% inflation target. So this cycle needs to reach its top before we start seeing a step downwards. And 3% isn't the top. I can only imagine what we are due in April, with national insurance rises forcing further price rises, particularly in sectors that are staff heavy. Then we have a 5% increase in energy on the cards in that month for domestic customers, up from a 1% expectation. We will find the exact increase out this week. It gets worse before it gets better, if you consider inflation to be bad. We do have to remember, other than the obvious impact on keeping interest rates higher for longer, that inflation is actually an incredible friend to the leveraged property investor. Wages higher, so rents can go higher, and house prices can go higher. Nominal debt is fixed, but prices go up together. The correlation isn't perfect, of course, but it's a near dream scenario here, to be honest. 3% inflation or 3.5% inflation. New buildings become more expensive, which drags up the price of the alternative, which is the secondary market already built stock. So what's the only slight upside to the overall economy here? Well, OOH, the owner-occupier measure of housing, didn't go up. And I've been waiting many months for this moment. But it didn't go down either. It stayed at 8%. But in 1 month, it's still too soon to claim it's definitely reached its peak. But if you look at how much all other inflation went up and OOH didn't go up, perhaps OOH has finally reached its peak in this cycle. And that will mean respite is coming, albeit slowly, as far as rent increases go, as far as the cost of mortgage increases go. So, this print of 3% generally is the highest print since March 2024, so we're nearly back to where we were a year ago, which makes perfect sense to me because 3% is the world we do live in. And the drop between April 24 and December 24 in CPI was simply the very, very high energy prices from 2022 and 23 dropping out of the figures as they actively disinflated. So they actually deflated. They were going down more than So prices were actually going downwards rather than just going up less, which is normally what happens. But that effect's going to drop out the figures again around April 2025, according to my calculations. So, news above expectations, but nothing surprising in any of that. The above target inflation is expected by the Bank of England to be worked out of the system well within the 3 years of its forecast period. But as I was saying back in 2021, I'm not convinced that it works its way out in quite such an orderly fashion. If anything, however, this is why property will remain a fantastic investment class throughout the whole of the 2020s. So, on to the PMIs. The nature of the calendar means that the third week of the month, which is always busy, is also the last but 1 week. So the PMIs got squeezed in on Friday. The report preserved the very negative headlines of the PMI reports from recent months. Sharpest decline in private sector employment since November 2020. Now, why doesn't that fit with December's unemployment figures not going upwards? Because this is talking about February. This is real time, remember. So we might expect unemployment to go up in January and February, given what we've seen over the past few months in the PMIs. But the tale of the tape is that clinging on is the theme, really. The flash index, the flash composite, printed 50.5. So 50, remember, is not growing, not shrinking. So 50.5 is only just above that. Services at 51.1, but manufacturing are really lagging now at 46.4. So the rise in private sector output was there, but it was marginal. Total new work decreased for the third month in a row and at the fastest pace since August 2023. Business activity expectations did, however, edge up from their 25-month low in January, although severe macroeconomic headwinds are noted, as is further geopolitical uncertainty. Now, the chief business economist at S&P invokes the word stagflation, referring to a growing dilemma for the Bank of England, which sounds about right to me. Just remember, if a central banker can, they will do nothing, and with signals either side, nothing sounds about right. He also talks of the price pressures put on by national insurance hikes, plus minimum wage that are incoming, alongside the intensifying job cuts. If you exclude the pandemic, employment dropped at a rate not seen since the financial crisis. 1 in 3 companies reporting lower staffing levels directly linked to the reduction in policies announced in October's budget. So there's nothing we didn't already know. As I say, holding on, above the watershed, but unlikely to be any exciting Q1 growth to consider. 0 to 0.1 would be the best current guess for Q1 as we speak. Now, NISA, the National Institute of Economic and Social Research, is predicting 0.4% growth in Q1, and the PMIs feel about as far away from that prediction as I've ever known since analysing these closely. What you've also got to remember about growth predictions is that they take inflation into account, and as I've said, inflation is higher than anybody thought it was going to be, economic consensus-wise, so that chips the growth figures even further. But what do I know? NISA are a huge organisation compared to me. Let's see who's right, Propenomix or NISA. I can be sure to tell you either way. So, hopefully I'm wrong, because I'd love to be. I'd love the economy to grow at 0.4% in this quarter. It would be brilliant. There are some that believe firms are deliberately misreporting in the PMIs to bluff or to send a message to the Labour Party. I've got limited belief in such a position, to be honest, and such an effort to attempt to change policy. I think firms just report what they're doing and why. But given a downside miss on unemployment and an upside miss on inflation, the gilt yields didn't fare too badly for the week. This is a continued real-life example of the fact the market has realised, in my view, that yields were already too high, and so no major adjustments have been needed. This week looked like a fair bit like last week. An attempted breakout to the downside on the yields on Monday, opening at 4.293, but testing 4.2 in the afternoon. But then Tuesday and Wednesday saw this big news released where these consensuses were missed on a side you would expect to expand the yields. So the yields did expand. They tested 4.35 on Thursday, but closed at 4.255. So it was a down week, actually, which is incredible. And as I say, these are the signals to listen to. When the yields come down on a week where they should expand, the wider market is saying these yields are already high enough or too high. We don't believe they should be any higher. So I really feel like we found our top in this cycle when we touched sort of 4.5 on the 5-year in early January. So it was a down week. That is incredible, but there was still a gap between Friday's close of the week and Monday's open. So that 4.255 is still higher than the close figure that I reported last week. And if that doesn't confuse you, nothing will. Still, the moves were nowhere near as volatile as the outturn numbers were, and the negativity in the PMI still drove yields back down, as some will continue to load up on the position that there might be a recession in the pipeline. Now, I don't think we've got much more than a 10% chance of a recession in 2025, but then if you'd asked me in 2024, I would have said a much lower chance than that at this stage of the year, probably more like 1 to 3%, so still much more likely than it was last year. So, Thursday's 5-year gilt yield close at 4.304 corresponded to a last traded 5-year SONIA swap of 3.983. So that's nearly 10 basis points up on last week, but again, almost identical to 1 month ago and 1 year ago, which suggests there's really some stability here on this front. So, expect 6% interest rates for no fee, as I've been saying for some time. That's my 2025 number. So there's limited positive news there, let's face it. So let's press on with the deep dive topics for the week in an effort to at least distract ourselves, if not cheer ourselves up. This first report from the Institute for Fiscal Studies, which was published last month, talks about young adults living in a parental home in the UK. I'll take you through the key findings with some commentary from me alongside. So, the proportion of UK adults in their 20s and 30s living with parents has risen by 1/3 in the past 2 decades. So this is focusing on 25 to 34s, and that number has moved from 13% to 18%, which might still be a lot lower than many might expect, or around 450,000 more in 2006 numbers. Now, it'll be more than that because the population has grown since 2006, of course. It's also more common for men than women, and it's particularly high in some ethnic minority groups, 23% for men, 15% for women. UK-born Bangladeshis lead the way at 62%, with Indian 25 to 34s at 50%. If you segment by income, almost 50% of those in the bottom 20% income quintile live with their parents, whereas only 2% of the top 20% earners live with parents. So this is interpreted as a form of transfer from the parent to the adult child. The opposite applies to direct financial transfers, as you might imagine. In the bottom quintile, 13% get direct financial transfers from their parents. In the top 20%, 54% do. So, what this says to me is that parents are finding a different way to do the transferring. Live with us, and we won't give you money to go alongside with it. Don't live with us, and we will. We're paying you to stay out the home, maybe, is one way to look at it. I don't have any adult children of this age yet, so I can't comment on that, although I was one once. Co-residence is much more likely when areas have seen particularly high house price growth since 2006, which is when the data used in this study started, the east, the southwest, the northwest, and the southeast. And then the expectation, if they'd modelled it out, would have been a decrease from 13% to 12%. So something else needs to explain this move to 18%. Now, lower rates of parenthood and marriage are also a factor. Marriage rates down from 39 to 29 in this age bracket, and those with a dependent child are down from 45% to 33%. Those with a health condition lasting at least a year are up from 17% to 31%, with half of that happening since the pandemic. The question here is it the cart or the horse? Do you live at home because you aren't married, or are you less likely to get married because you live at home? The estimated amount of rent saved is £560 per month on average, and £1,000 in London. Now that feels low, but maybe that is the cost of an HMO room. But is rent what we should consider really though here, or should we be talking about the total cost of housing, marginal extra bills, council tax, etc., etc.? Co-residers are 3.9% more likely to have accumulated £10,000 or more in net financial wealth over a 2-year period. So not hugely more likely, but statistically significant. But co-residing is also associated with a higher likelihood of a large decline in net financial wealth. People who move back in with their parents after an adverse event like a divorce or a separation with a partner. Certainly when I was between 25 and 34, that was one of the things that happened to me. So, let me pull out some of the more interesting, finer points of the report. 43% of 25-year-olds are in a parental home, compared to 9% of 34-year-olds. So the action within that age band is really considerable. And that 9% 12% are men, and 5% are women when they get to 34. So, more than 40% of all early to mid-50s have at least one co-residing adult child who is 18 plus, and more than 50% of parents of that age do. Incredible, really. London has a lower rate of co-residence than you might expect, but this is explained by so many people in this age bracket living in London because they work there, but not having parents who live in London, so the option isn't even there for them, really. The concentration is in both owned homes and social homes, and co-residency is much, much less common in a private rental. And when I think to tenants and family situations that I know and understand, I can only think of a very small handful of rentals where we've got multi-generational co-residing going on with adult children. Now, there's also 42% who don't live with a partner and are in that age bracket are living with their parents. 32% of those who are unemployed in that age bracket live with their parents, and another 25% of those who are economically inactive, which remember means they don't have a job but they're also not looking for work, so they might be a student, might be long-term sick, there might be other reasons for that. In theory, early retirement is a reason, but in 25 to 34s, I don't think there'd be too much of that, to be honest. But 18% of those who are employed are living with their parents. Now, there's a big emphasis on rent saved being a factor here, but not just rent saved. Suitable available properties is also explored. Private rent is the benchmark because obtaining a social property, especially without having a dependent child of your own, is particularly difficult. So the conclusion drawn in the report is the change in housing costs is 90% responsible for the change in this co-residency situation. And this is the most disappointing conclusion I've ever seen in an IFS report, to be honest with you, because I do have a great deal of respect for the IFS. They tend not to have too much of a political agenda. They're pretty central on their views, and normally they're pretty robust. But this holds extremely little water for me, and unfortunately they don't go to the level where they should. They think they're proving something that they already knew. But rents are a smaller percentage of income in 23-24 than they were in 2006-2007 when this survey starts. Plus, houses are cheaper once adjusted for inflation, and even cheaper when adjusted for wage inflation. So how can this explain 90% of the difference? Instead, the report touches on but mischaracterises a major factor in my view. In 2006, 26% had a degree in this age bracket, compared to 50% by the end of the study. Twice as many had a degree, so twice as many had another 3 or more years of not earning and taking on significant debt. Add to this that in 2006, no one in that age bracket had paid more than £1,000 a year in university fees, because 2006 was the first year of the introduction to 3,000, which became 9,000 in 2012. So 9 times the fee, inflation aside, has not even been considered to be a significant part of this analysis. Now, this has got to be fundamentally methodologically incorrect. The report has started with the answer and then gone back and fitted the data to it. Now, that in itself is disappointing, but understanding the direction of travel might help a few parents out there, or might help a few landlords and investors make a few decisions. So this report tied in nicely with a recent effort by the Resolution Foundation. The likelihood of Res F ascribing the change in housing costs, as before, not actually defined in the data, to creating more problems for people in the 25 to 34 age bracket was high. And this is why I mentioned this report in passing when it was first published in the supplement. It was a surprise to see the conclusion drawn that home ownership prospects had improved for those born between 91 and 95 compared to those born between 81 and 85, although ResF couldn't quite bring themselves to really conclude that, and instead led their own personal review of the article with a remarkably positive development in the largely bleak landscape of youth home ownership. Now, there's a bit of irony in the timing of all of these reports, of course. They rely on the latest English housing survey, which only contains figures until March 2024, and rents have been rocketing since then, and interest rate normalisation has been ripping through those with mortgages whose fixed rate period has expired. Nonetheless, we can't just wait for 5-year cycles or whatever to play out, so we do have to press on with trying to analyse some of this in the face of the changing market. And why do we spend so much time looking at these reports and talking about them? Because these are the sort of things that will be making the arguments to the politicians. These are the messages that will get through to those setting policy. So it's extremely important to understand what these reports say. So the key findings in the ResF report: change in home ownership by age 25. 14% of people own their own house by age 25 compared to 13% a decade before. Now, I polled my audience on LinkedIn, who are an educated audience, right? And their impression, mostly because they listen to the media too much, I'd imagine, was that 1.4% was the likely home ownership rate of a 25-year-old. I offered something like 1.4%, 4%, 7% and 14%, and less than 5% of people chose 14% because there's so much doom and gloom out there. But 1 in 7 25-year-olds owns their own home in the United Kingdom, and there's supposed to be, some kind of tragic crisis going on. It just doesn't make sense, does it? We can't possibly suggest that 1 in 7 all come from gigantically privileged backgrounds and all the rest of it, because that's not the definition of privilege, is it, apart from anything else? So 25 to 34-year-olds home ownership rate is up by 600 basis points from 2015 to 16. So it went from 25% to 31% in 2022. So we know there's 14% by age 25. You can figure out if the bracket was 31%, then a good 50% of people are owning their homes by age 34 in 2022. Again, doesn't sound that tragic, does it? It's a dramatic change upwards, and you'd have to ascribe that bottom in 2015-16 to the impact of the financial crisis finally being bottomed out, realistically. Then in 22 to 23, 22% of income was spent on housing on average, which was down from 27% in 2015 or 16. Again, you just wouldn't believe this if you read the headlines at the moment. Now, in 1990, 55% of 25 to 34s owned their own home. So it is still significant slippage from then 55 down to 31, right? The private sector has picked up all of that slack because 33% are in the PRS compared to 10% back then. 1 in 3 renting in that age bracket, right? And parents have picked up the rest, as the IFS report has shown. And then home ownership rates are up more with those with more income. I don't know how useful that conclusion or statistic really is. We do live in a merit-based capitalist society, so people who earn more money are more likely to own houses. I don't know if anybody should be taking anything from that or apologising for it, quite frankly. In the lowest income, 20%, the percentage of income spent on housing costs is 53%. High housing costs directly impact savings. Again, you would expect so. 13% with high housing costs report anxiety, versus 8% across the age group and 1% who have no housing costs. And then the final conclusion is the fantasy that the government will deliver its target of 1.5 million homes. I'm sure I've said enough about that one over time, but also they need to recognise the need to relink LHA with the 30th percentile of market rents. So I just want to focus on the second half of that final conclusion for a moment, because this is perhaps the single most monumental piece of stupidity that I've seen in housing policy in the past decade plus. And I realise that's a substantial and outrageous claim, because just look at the litany of other things that I could choose. But this one really does stand out to me. And I'll tell you why from my experience at the coalface. You've got a decent number of properties in our group that are leased to housing providers. 3-year, 5-year, 7-year, perhaps even longer lease arrangements. You might be familiar with them, and you'll certainly be familiar with some of the names who are doing the housing provision, even if you've never entered into an arrangement like this yourself. Serco, for example, blue chip listed company. I'm a big fan of these agreements as an aside. It's a decent hedge against the changing face of the PRS. There's more social impact. I certainly feel a larger sense of satisfaction that the portfolio is making a positive contribution to the parts of society that really need it. They're also commercially viable, of course, which is helpful. But I've never been a big fan of those who apologise for making a profit. I recently wasted my time, frankly, defending myself and landlords in general on a social media post by pointing out just how many uninhabitable, uncompliant, unpleasant homes that I've refurbished and made decent, watertight, weathertight, free of damp, etc., and then offered back to the market in spite of the macro environment for landlords largely being against me for most of that time period. Anyway, after that segue, here's the step change that I want to tell you about in the rhetoric from 12 to 15 months ago. At the turn of 2023-24, we knew that LHA was going up, and at the end of Jan 2024, we found out by how much. It was actually 17% on average from the 2020 rates. However, even before we did know that, the conversations with these housing providers were still very much based around LHA at the old rate for rents. For example, we were being offered LHA plus 35% on the 2020 pricing. LHA was the benchmark. LHA was the Bible. Now, after a few political whispers and also just being pragmatic and reading between the lines, there's a complete difference in language in early 2025. Providers openly saying LHA isn't even a consideration anymore, market rent is the conversation. So I'm not sure I need to bother with this next bit because it seems so obvious to me, but I will. LHA is, as the Resolution Foundation final point states, based on the 30th percentile of the market rent. Before the 2024 adjustment, in just 4 years, it had slipped in some areas of the country to the 3rd, 4th or 5th percentile, which would mean only between 1 in 20 and 1 in 33 properties would be affordable on the local housing allowance. With low void rates and long periods between turnovers, it had got to be completely useless. This then led to people being put in temporary accommodation instead, if a landlord sold up or a tenancy fell apart, at a rate drastically more than the market rent, let alone the 30th percentile of the market rent. If that doesn't happen much, then overall, the argument would be the public purse saves money. As long as you don't consider the other impacts of being homeless and the massive increase in demands on public services outside of just LHA, of course, which is a typical government saving money by not saving money at all, just kicking a can down a road or putting a line in someone else's spreadsheet rather than their own. So if this government is so ideologically opposed to housing benefit, which it appears it is, the destruction of it will see all conversations around temporary, around properties leased to a provider for one of 25 or more purposes be based around the market rent. Now, one more mathematical anomaly here. The market rent is captured by the valuation office from a sample of landlords. Some people listening to this may have been approached in the past, or they may submit their rents directly to the VOA. These are existing rents. Then the 30th percentile of those existing rents is taken. We then move from there to market rent. Now that's not the 50th percentile. Market asking rents are around 13% above. Market existing rents are around 13% below new rents, according to the ONS, who use a sample of 550,000 rents that they get from Dataloft to do their analysis. So that would shift you up the centiles, not necessarily to the 63rd centile either, because that's not how the maths works. But as an estimate, it's likely much worse than that. I took the 3-bed LHA for my own postcode, and I added 13% onto the rent at the 50th centile, and it appears that would land somewhere between the 80th and the 85th centile, and would actually be about 37.5% more expensive than the rent at the 30th percentile. Now that's not supposed to be a robust mathematical analysis, of course, although I do get concerned that it's more robust than the calculations that are being done within Whitehall. But if that's anywhere nearby, the cost becomes 37.5% more, plus the extra cost of not being in a stable private tenancy that's set up for LHA, and being in a temporary property on a licence or similar. What progress the Genii in Westminster are making with this policy. Was that sarcastic enough for you? So, it would be fair to say that I agree resoundingly with the Resolution Foundation's conclusion, and any accusations of me talking my own book here are badly misguided. I'd be worse off if we were still having these conversations around LHA, not better off, which I am today. I also, as one more aside, see a fair few properties on the market where the landlord has been somewhat old school, and there are LHA tenancies at LHA rates from 10 or more years ago that have never been put up, even though tenants are in receipt of the local housing allowance. So a higher LHA rate isn't necessarily always being taken advantage of anyway. These properties leave plenty to be desired from a compliance perspective, of course, usually. I can and will also levy the same accusation against the Resolution Foundation. They just haven't controlled for the increase in university attendance and its impact particularly on the fortunes of a 25-year-old. There's other arguments. Life expectancy is up, meaning that today's 25 isn't the same as 2006's 25. Degrees are not only more prevalent, they are longer on average, with many more opting for masters and even PhDs, and they wouldn't even be finished by age 25. So, as so often, the cause is noble, but the inherent bias and the accepted truths really need challenging for a proper piece of work to be done in this area. I doubt that will ever be funded, though, because all of these think tanks have their own agenda, whereas the truth remains my agenda. Why does the truth remain my agenda? So that I can work out how this market is going to continue to evolve. So I'm sorry to tell you that the market is just going to continue to evolve in favour of the asset owners and against the tenants, and against the younger members of society. So your job, realistically, is to do everything you can while the window of opportunity is open before corporations figure out a way to take over the entire private sector, to the detraction of everyone other than the shareholders of the corporations. What am I doing about it? I'm becoming a corporation. So, as I draw to a close once more, I'll just take the opportunity once again to remind you of the sourcing course I'm going to be delivering on the 21st to the 23rd of March alongside Dan Kennedy and Nick Bond. It's all sausage, very little sizzle, real-time examples of how we find deals on a daily and weekly basis, an experience of many tens of thousands of deals analysed to lead to over 1,000 deals being done between us all. There's a reason we call it Sourcing Solved, because that's what we're aiming to do. There are information and tickets at propertymatchmaker.uk/sourcing-solved, and there's also a link in the show notes. And also remember, please, to book your tickets for the 1st of April, Tuesday, for the next property business workshop, Due Diligence, the single most comprehensive day on due diligence that will ever have been delivered in the property space. I can guarantee it. Join those who've already booked their super early bird tickets and grab yours at bit.ly/PBW and then a number 6. And that link is also in the show notes. So above all, especially after a deep dive as detailed as that, please remember, keep calm, always listen to the supplement and carry on, because there will be opportunities abound this year and towards 2030, regardless of what policy actually ends up being. Of that, I have no doubt. Thank you, folks.